Yeah, so Expedeon is a tools and reagents company, a life sciences tools and reagent company. So not your typical diagnostics or drug discovery company. We basically make innovative enabling tools and products that we sell into the life sciences research kind of space, both academia and industry, and we help those people develop their new drugs and their new diagnostics products. That's kind of our main core business. Yeah, so Expedient has been deploying this grow, buy, build strategy, and there's three distinct facets to that strategy. So the first element is the growth element of it, and that's really driving organic growth. So as an organization, we continue to spend a lot of investment into research and development. So we want to continue developing new products, and these new products we want to sell into our ever-expanding customer base. We invest heavily also in developing our own sales and marketing infrastructure. So we have a sales and marketing team now, which is about 35 people strong, which is about 1/3 of the group in total. So by building up that sales infrastructure, by continuing to invest in new product development, we want to drive our organic growth and really grow the company strongly from that point of view. Now, the build side of things is to expand and really get to scale faster than we can do just by organic growth on its own. So with a lot of these things, once you get to a certain scale, you get efficiencies, your margins increase. You really can accelerate the growth and get to that kind of position of leadership faster than you can do just through organic growth. And this kind of M&A strategy that we've deployed over the past 2 years has really helped us in really shaping that organization and getting it into a position where we have an engine which now really can fire on its own kind of steam and drive the company forward. Then the final part of it is the build part, and that really is much more the longer term play that we have on some of the technologies that we've developed and acquired. As I mentioned in the first question, our core focus now is on the research use applications of our technologies and our products. But what we do see is there's a lot of pull from diagnostics companies into pulling our technologies into the final diagnostics or drug manufacturing. But that requires a little bit more time, and it requires us to nurture the technologies and really enable them to get the best out of them further down the line. So that's kind of the build element of the strategy. So the company has been pretty active in the M&A space. So Cygnus, well, at the time the company was still called Cygnus, acquired Expedeon back in 2016, and that's when I joined the Cygnus Expedeon story. So we've kind of been very acquisitive since then onwards. So we acquired CBS Scientific in 2016, which is in the electrophoresis space, really bulking up the expertise we had already in that area. Then in May 2017, we acquired Innova Biosciences Limited, and that gave us some initial exposure into the reagent immunodiagnostic space, which was then complemented with the TGR transaction in 2017, just recently, really adding to this kind of immuno space technology. Now, in terms of what we look for in an acquisition partner is really synergies, complementarity. So the first objective is to really build a strong organization from a technology point of view. So all the pieces of technology that we acquire need to fit together, which then gives us sales leverage and allows us to then build our customer base. But in the early acquisitions in particular, we needed much more than just technology synergies. We were also looking for complementary customer bases. I mean, if you look at Expedeon, its customer base originally was much more focused on the academic kind of world. Through the acquisition of Innova, we acquired a very strong industrial kind of based customer-based focus. Now with the TGR transaction, we've kind of supplemented the industrial customer base, but again, slightly different to the Innova customer base, which was more diagnostically focused, whereas the TGR customer base is more pharma focused. So you can see that through the acquisitions, we've been able to really expand and enhance our customer offering. Also, in addition to the technology base that we then acquired, which now allows us to cross-sell our different products and technologies into the different sales channels that we've acquired as well. And now in the early days as well, Expedeon was only 20 employees. We needed to expand the company very aggressively. So we've gone from 20 employees to about 150 employees now. So through these acquisitions, we were also looking for human resources, really strong people, and through these acquisitions, we've been able to really build a strong marketing team, a strong sales team, a very strong manufacturing team, and of course, we have some world-leading R&D development skills as well. So all of that has come together through the acquisitions. Now the focus is slightly changing, where we're looking also for very strong financial metrics. The company has now moved into a positive EBITDA, and when we're doing acquisitions now, we're looking for ways to really drive that EBITDA and drive, in addition to, of course, driving the top line. So we're looking for companies that can help us build the profitability, and where we can see now maybe some cost synergies in addition to some revenue synergies to really help shape both the top line and the bottom line of the organization. So the company kind of has 5 core technologies now in its possession, and of those 5 core technologies, we've developed a product range which spans more than 1,700 SKUs. So we have a lot of SKUs, but really it all hinges around 5 core technologies. So TruePrime is one of our core pieces of technology, but in terms of instant revenue generation today, it's probably not as important to us. It really has a lot more longer term potential as the sequencing market and the cost of sequencing comes down, and the new liquid biopsy, sequencing-based liquid biopsy wave really hits the shore. We'll be able to ride that wave. So that's more of a longer-term kind of potential. In terms of short-term revenue generation, the electrophoresis kind of product offering is a very strong revenue generator for us, and gives us some good growth as well. But the most excitement for us sits in the immunodiagnostic space now. We have capture technology, we have lightning link technology, and colloidal gold particles that we make as well. And all these pieces kind of fit very well together in this kind of immuno-based sandwich antibody-based immunodiagnostic space. So we target both applications for research use, but also clinical diagnostics. Early stage, of course, focuses on the research use only applications, because that doesn't require any kind of regulatory hurdles and allows us to bring product to market much faster. But ultimately, we see a lot of potential as well in that kind of clinical diagnostic space. Okay. So the company has fundamentally changed since 2016 when I joined the organization. In 2016, the organization was on a burn rate of about 4 million euros a year. And our first objective was to bring that company onto a healthy financial footing. So Q4 last year was our first objective to get to a break-even kind of position. We've reached that target. And now this year we've been continuing to build our EBITDA position and building our profitability. So from a financial point of view, the company is now really able to stand on its own 2 feet and fund its own kind of development track. We've been able to do this, through our grow, buy, build strategy, and the buy element of this has been very important, and the market has been very supportive to us in terms of providing us with the necessary capital to go out and acquire these companies and bring them together into a single entity. So historically we've been funding our acquisitions through equity, but we're in a position now where that's changing. And actually, if you look at our last transaction, TGR, you can already see a slight change there, where part of the consideration was now paid through cash flows from the business, or from future cash flows from the business, rather than equity from from the company. So and that's a trend that we want to continue on. So for this year, we've now we're able to secure some debt financing from an outfit in the UK. That finance can then be deployed into future acquisitions, which will be non-dilutive, and that's something that we're really keen to do, to really move that kind of focus from equity onto non-dilutive kind of measures of financing transactions. Having said that, equity will always form an element to this. I mean, if you look at our historic transactions, there was always an earn-out element there, where the vendors are kind of rewarded for the success and the growth of the business that we're acquiring, and that is always an equity element that we want to retain there and really share some of the risk with the vendors of whom we're buying the assets from. So in terms of financing, the picture is changing from equity to non-dilutive ways. In terms of what we do with the acquisitions, our objective really is to build a vertically integrated organization. We're not into like a simple kind of roll-up story where we just buy lots of different companies and let them running on their own steam. We're looking for synergies, we're looking for complementarity, and we really want to bring that out by integrating the organizations into a single entity and try and consolidate as much as we can. So in the UK, for instance, we acquired Innova Biosciences Limited, which is Cambridge-based. That has been folded into Expedeon Limited, which was Cambridge-based as well. In San Diego, we acquired CBS Scientific, which has been folded into our site in San Diego. But of course, we still have some exposure in Spain, for instance, where we have our R&D facility, which is a legacy TruePrime R&D facility. it's very difficult for us to move this because we're tapping into local universities and local expertise. So we want to retain the knowledge base there and then make sure that we can extract the value out of our technology rather than moving the asset over to the UK where we potentially lose some people skills. Likewise in Australia, we have some core expertise there. In terms of commercial development, most of that has been moved to the UK because the commercial partners are based in the US and in the UK. So it's much easier to have those conversations in the same time zone. But in terms of R&D and local manufacturing, some of that will retain in Australia. So in a nutshell, where possible, we try and consolidate into our hubs in either San Diego or in Cambridge in the UK. But that's not always possible, and you have to retain some sort of activity in the local regions where needed.